The Backdoor Roth IRA. So, you think you're all fancy, huh? Heard about this Backdoor Roth idea and you're all excited? Well, hate to bust your bubble, but in this video, I'm going to tell you why you can't do it. But don't worry, if you keep watching, I'll provide you with a solid foundation of understanding so that you will be able to do it successfully one day. All right, let's get to work. What's up, guys? I'm Kishal. Welcome to another financial awareness video. We're going to keep this short and sweet, so buckle up. First, a quick review of what a backdoor Roth IRA is. Then I'm going to hit you with some numbers and stats, nerd stuff. Then I'm going to tell you why you can't do it, and then we'll wrap it up and put a bow on it by sharing with you how you could have a positive and successful backdoor Roth IRA experience. So what is a backdoor Roth IRA? Well, it's a fancy sales term that financial advisors like to use to sound intelligent. In the eyes of the IRS and legal terms, it's a Roth conversion. You might want to check out this video right here. A backdoor Roth conversion is simply when you make a non-deductible contribution into your pre-tax traditional IRA and attempt to move or transfer those funds from your pre-tax traditional IRA over into your after-tax Roth IRA. No, I'm not going to waste 8 minutes of your life by doing a screen recording and showing you exactly where to click and how to do it. You're a grown adult, you could figure it out. Or, I don't know, maybe I'll make another video about that. Okay, numbers and stats. Here comes the nerd stuff. According to the IRS, based on how much money you guys made in 2018, there were over 41 million tax returns with the status of married filing jointly. Of those, only 7.2 million made over 200 grand a year of adjusted gross income, which is 17.3%. So, to the 86.7% of you watching this video, you don't need to do a backdoor Roth IRA. Your income qualifies to simply make a normal $6,000 contribution for yourself from your checking account and an additional $6,000 contribution for your spouse, assuming your spouse works and makes at least 6 grand. If you're a single income tax filer, then these numbers aren't exactly perfect because you're phased out from making Roth IRA contributions between $125,000 and $140,000 for the 2021 calendar year, and these figures are based on 2018 earned incomes back when the phase-out limits were $120,000 to $135,000. But if you'll indulge me a little here and extend some grace with these figures, then you'll let me make my point, which is that if you basically made over $100,000, then you were among the 4.6 million people, also known as the top 9.5% of single income filers in 2018. And if that's you, then no, you do not need to do a backdoor Roth IRA either. You can simply make Roth contributions like normal. So if you're following along, then you've determined by now that the backdoor Roth concept is really only for people in the top 17 or 9.5%, or perhaps people that aspire to that income level as well. Dude, I really need to broaden these video topics for more people. Why you're stupid to do the backdoor Roth IRA. Many times throughout life, there's the story and then there's reality. The story of the backdoor Roth IRA is very glamorous to talk about, but in reality, there's a lot more red tape you've got to navigate around, so pay attention. If you're single, making more than 140 grand, or married and making over 208, then chances are you've climbed the corporate ladder over the span of your career, have probably changed jobs more than once, and have had some financial success in growing your 401k. Good job. Yes, when you leave one job and move over to the next, you can roll over your old 401k into your new employer's 401k, but sometimes your new employer doesn't have a 401k, or you do what nearly every other person does and you roll that old 401k over into a pre-tax traditional IRA. This means that you now have pre-tax dollars in a traditional IRA because when you go from a pre-tax 401k over to a pre-tax traditional IRA, there are no taxable consequences and you get to manage the money as you see fit within your own self-directed IRA or through your financial advisor. This happens for many reasons, but I'd say it really happens for 2 or 3 main reasons. The first one would be most people don't want to pay the tax bill on rolling something like this over from a pre-tax account over into a Roth account because that could potentially jump them up a tax bracket, or they just simply don't have the out-of-pocket expenses to pay that bill. And then also, you have a lot more investment options to select from within a traditional IRA that you can manage yourself, as opposed to maybe 17 or 20 different options within an old or new 401k. And then I'd say the third reason why this usually happens is because unless your financial advisor is directly managing your new employer's 401k or your old employer's 401k, they have no financial incentive to recommend that you keep that money there, and they're probably going to steer you in the direction of doing a rollover into a traditional IRA with them because, well, that's how they make money. No taxes to you, more investment selections, and they're going to start making a few bucks now. You probably ended up with money in your pre-tax traditional IRA instead of an after-tax Roth IRA or your new employer's 401k for any combination of those reasons. So what does all that mean to you and this video? Well, if you have $94,000 in a traditional IRA and you make too much money to be able to do a normal Roth IRA contribution, then congratulations, you're doing fantastic and I'm super happy for you. However, here's the rub. In regards to this backdoor Roth IRA situation and concept, there's this thing called the Aggregate Rule. The Aggregate Rule? Yeah, go Google it after the video. You have to add up or aggregate any pre-tax funds within your SEP, simple, or traditional IRAs, but not 401k or 403b plans. More on that in a moment. For the sake of argument, let's say you don't have a SEP or a simple and only have that $94,000 in your pre-tax traditional IRA from your $60,000 or $70,000 rollover that you rolled over years ago and haven't touched for a while. Well, if you want to take $6,000 from your checking account, which has already been taxed, and contribute that into your traditional IRA, that would be a non-deductible contribution because you make too much money to get the deduction. However, you now have $100,000 in your traditional IRA, and the goal and intent was to take that $6,000, which has already been taxed, and move it over into your Roth IRA so it can grow tax-free. Unfortunately, even though it's 2021 and we can make vehicles that drive themselves, apparently we can't distinguish a fresh after-tax $6,000 from the original balance of $94,000. Nah, just joking. You're going to want to fill out Form 8606 noting your non-deductible IRA contribution. Here's the math equation for the Aggregate Rule or Pro Rata Rule. You take your non-deductible contribution and divide it by the aggregate of all your pre-tax accounts. So in this example, $6,000 divided by $100,000 is only 6%, meaning that you can only move or transfer 6% of your $6,000, which has already been taxed, from your traditional to your Roth IRA without incurring any additional taxes, which is only $360. The other $5,640, which has already been taxed, can't be moved over to your Roth without paying taxes on it again. Time out. If you like paying federal income taxes on money you've already paid federal income taxes on, then you need to tap the like button, hit subscribe, and binge watch my entire content library and wake the How can you have a successful backdoor Roth IRA experience? Okay, we're going to do this in 4 steps. Step 1, you've got to get rid of any money within your SEP, simple, or traditional IRA. And the way you do that is you've got 2 options. Option 1, you actually can do a Roth conversion and pay the taxes on that money that you convert over into your Roth. Option number 2, if it's available to you, is to transfer the money from your IRA into your current employer 401k or 403b, because those plans are governed by ERISA and not subjected to the math equation for the Aggregate Rule. That first option, though, of paying taxes and actually doing a Roth conversion is going to cost you some out-of-pocket money, but in my opinion, it is absolutely worth it if you have a 20 to 30 year time horizon, which would allow that money, which would then be in your Roth IRA, to grow and grow and grow tax-free instead of growing tax-deferred. However, before you do that, you're going to want to watch these 2 videos about Roth conversions and tax bracket management. Step number 2, now that you have $0 in your SEP, simple, or traditional IRA, you can now go ahead and contribute that $6,000 after tax into your IRA, which will be deemed a non-deductible contribution. Do not invest this money yet, though. Since you now have $0 in your traditional IRA and you're adding $6,000 to it, and the goal intent is to take all of that $6,000 and backdoor it over into your Roth IRA, do the same equation. $6,000 divided by $6,000 is 100%. Meaning that 100% of your backdoor Roth non-deductible contribution can be converted over into your new Roth IRA without incurring any additional taxes. It is a non-taxable event. Step number 3, you now go ahead and invest that $6,000 within your Roth IRA based on your risk tolerance and time horizon. And step number 4 is for either you or your CPA to properly fill out Form 8606 along with your next tax return, noting your non-deductible contribution. Link to the IRS website and form down below. If you've got a few more minutes, here's the video about Roth conversions, tax bracket management, or I don't know, maybe you'll like that one instead. If you have any questions for me, let me know in the comments down below. I appreciate your time. See you in the next one.